It's now been 6 weeks since you were tapped to be sole president and CEO of Goldman Sachs. Congratulations, by the way.
Thank you very much.
For shareholders and for you, I'm sure, this move provides clarity and enables you and the firm to look ahead. So I wonder, what does it free you up to do? What are your priorities right now?
Well, my priorities continue to be to help Lloyd run the firm, as president and chief operating officer of the firm. We had a very, very good first quarter. We felt good about the first quarter. But as I think you know, because we've talked about it publicly, we're focused on our growth initiatives, a $5 billion growth plan, and we're focused on our client franchise and making sure, in this environment where there's opportunities to help and support our clients, that we're executing extremely well. So yes, a change in our process and the way that process goes forward, but continue to focus on the same things: our clients, our business, our people.
How does it feel to be the chosen one?
Well, as Lloyd said on television a couple of weeks ago, I'm his fourth COO. So, I don't, who knows what I'm chosen for, but I'm the fourth COO, and, I'm excited to continue to work with Lloyd and the rest of the leadership team, help the firm move forward.
To the degree that you can, or let me ask it differently, how much latitude do you have to set your own priorities? And how much of it is a discussion, an agreement, if you will, between Lloyd and perhaps even members of the board?
Well, we have a very, very collaborative culture, and our leadership team, the management committee of the firm, works together to drive our initiatives. And Lloyd and I work extremely closely together. And when Harvey and I were working together, Harvey and I worked very closely, with Lloyd to make sure we were driving the firm forward.
Now, over the years, Goldman Sachs and other Wall Street firms have had to beef up their compliance departments in response to increased regulation. We're in a different environment now that is emphasizing deregulation. What is the thinking on the opportunities that might exist to organize or structure the organization better to be more nimble, more profitable as a response?
Well, one of the things that we've always thought has been a great asset of the firm is extremely nimble, extremely flexible, and we try to focus on, maintaining an entrepreneurial culture that we've had for a long, long time. I think it helps us serve our clients well, and it helps us run our organization. The regulatory pendulum might be swinging a little bit, but the momentum that's been created over the course of the last 10 years to have a bunch of processes, there's not a significant shift in that. And, look, over time we monitor, what we need to do from a regulatory perspective, and if it does change, we'll adjust accordingly.
There's a slightly playful, slightly pejorative term for this structure inside Goldman Sachs, right? The Federation?
I wouldn't say that it's pejorative or even playful. The firm,
it just is what it is?
No, the firm has created a culture over a long period of time to really make sure the areas of the firm that support, our focused activity, our operating businesses, and their focus on clients are extremely well supported. And, the quality of our people across all our Federation businesses is really, really important to the overall success of Goldman Sachs. So it's a very, very important part of our organization.
Is there too much bureaucracy? In other words, I'll just invoke someone else's name. Jamie Dimon said in his annual letter to shareholders that he's at war with bureaucracy. Are you at war with bureaucracy?
Look, I think all big organizations always have to strike a balance between process and trying to be nimble, flexible, and entrepreneurial. I saw, what Jamie wrote in his letter, and it's something that we talk about all the time in our organization. But I think that we run a good organization in terms of being nimble and flexible, but there's always room to do better, and that's one of the things we spend time focusing on from a management perspective, is making sure we're serving our clients well, but being extremely efficient, but also having great processes, great risk management. That's something that served the firm extremely well over a long period of time.
Your organization will be celebrating its 150th anniversary in 2019 next year.
Yes.
Is it reasonable to assume that Lloyd Blankfein will stay on as CEO through this important milestone?
You'd have to ask Lloyd and the board. But we're very excited. And there aren't a lot of companies that are around for 150 years, under the same banner, the same mantle. And look, we're very excited about the next 150 years for Goldman Sachs, but it'll be a nice time to kind of commemorate the history of the firm that's helped us get to the position that we're in today.
David, could you please do everyone in financial markets a favor and explain the difference between good volatility and bad volatility?
I don't think that I can explain the difference between good volatility and bad volatility, but what I would say, okay, is that the first quarter was an environment where, for a variety of reasons, our clients were more active in shifting around portfolios and changing, some of the assets they were holding or the positions that they had. And in that kind of environment, given the strength of our FICC franchise, you actually saw it perform very, very well. And you look at our returns in the first quarter, they're reflective of the fact that when clients are more active, we're going to benefit in that business.
Does that reflect more conviction on the client's part? I mean, you spent a lot of time traveling around the world, meeting face-to-face with the big clients. What are they telling you in terms of their conviction?
Well, I think that you talk to different clients, you get different conviction about different things. It can be because of conviction, but it can also be a shifting landscape. And look, I think there's no question in the first quarter there was more of a sense that rates were really moving, or we were heading into an environment, particularly here in the US, where rates were moving, and that was getting people focused on shifting the way they were positioned. In terms of getting around and talking to people, generally speaking, people are relatively upbeat when you're talking to CEOs. Right now, CEO confidence is relatively high, but people are also cautious. Any way you look at it, we're somewhere late, in this growth cycle.
Yeah.
Could run for a while, but at the same point, people, I think, are cognizant of the fact that asset prices have been going up. There's a shift in monetary policy going on around the world, and that could lead, to some changes or some shifts that people want to be cautious about.
David, broadly speaking, is Goldman advising that now is a time to take more risk, hedge, or cut your exposures? You ask the question in a way as though there's a black and white answer. What asset class, how is the client positioned? Look, I'd say it's a time to be cognizant of the fact that we've had a cycle that's run for a long time and the environment is changing, maybe normalizing. The cycle could run for a number of years, from here. Growth feels pretty correlated at the moment, but there's certainly things that can disrupt it in some way, shape, or form. And so, I think people need to be nimble but cautious, but you've got to participate as an investor. You have to be invested. You can't sit on the sidelines. How important, in your opinion, is the 3% threshold on the 10-year Treasury?
It's just another threshold, another benchmark. I think the issue is not just simply, in the short term, the 3% threshold. The issue is what is the trajectory of rising rates, and have the markets priced appropriately that trajectory? And look, at the moment, the sentiment is that this process of rate change is going to be relatively gradual and relatively transparent. If you go back and look at other tightening cycles, it generally doesn't play out that way. At some point in time, the sentiment shifts, and the change in markets reprice more abruptly than people expect.
Some people say times are good. It feels a little bit toppy, perhaps. Do you see any evidence of undisciplined behavior in the markets as people reach for yields? There's a lot of talk about the return of covenant-light loans, for instance, as a potential red flag. Is that a red flag to you?
Look, I think we're down the road in the cycle, and so there's certainly places where I think people are further along the greed spectrum than the fear spectrum. In an environment where money has been so inexpensive for such a long period of time, there's no question that people have been reaching for yields until recently, and if they've got duration on, they might be more vulnerable. I think people have been reaching for growth, and you look at a bunch of these growthy companies, and the value that people will pay for forward growth has been very, very high, and at some point that may correct or rebalance a little bit. But it's hard to say how quickly that will occur.
David, what signs do you look for to determine whether, in your view, there's too much greed?
Look, our job is, as we think about the advice we give our clients, is to try to provide people with information, transparency, things that can help them make the right kind of decisions. We're not great forecasters, but we're good at, looking at the environment and saying, okay, what makes sense, what doesn't? Do you want to be exposed here? Do you want to hedge? And so our job when we're serving our clients is to try to help them, think through these issues where the answers aren't clear, they're not black and white, and they're also not the same for every client. And so, our job is to figure out how to take the resources of the firm, our market access, where we sit, everything that we see, and help clients make good decisions.
Let's talk about the landscape overall for Wall Street banks. Deutsche Bank's announcement that it's going to be retreating from the U.S. markets. How does this fundamentally alter the competitive landscape for you?
Well, a lot of people have talked about retreating from a bunch of these businesses, and if you're a significant market share player, you don't mind seeing people retreat. But we'll wait and see if anybody actually does retreat.
So you're not sure it's going to happen?
I'm watching. I'm not inside Deutsche Bank. I watch their statement. I think that's an institution that's in a position where it's going to need to change or evolve, but we'll watch and see. Certainly if a big institution steps away from some of the institutional businesses in the United States, we are one of a handful of institutions that should have an opportunity to benefit and take share in that environment. But I won't predict that. We'll watch and see and serve our clients, well. And if we do, we should benefit from that if it happens.
At the same time, there remains a very strong bid for talent.
Yes.
Is it getting too expensive to hire good people?
Well, look, I think having world-class talent, having a really diverse workforce, incredibly important for an organization like Goldman Sachs. And I'd say that the war for talent in this world is more intense. I think
more intense than ever?
Not more intense than ever, but it's intense because the world is much more transparent and people have much more mobility and people can be connected to all different things. And so I go back to 30 years ago when I started in the business, 35 years ago now, and people, got in their lane and you worked the talent universe that was in your lane. The world is much more open and people can move around and do different things. I think there's a greater interest or propensity that young people have today to try different things and gain different experiences. And so to be a successful organization, you've really got to treat your employees well. You've got to give them great opportunities, and we work very hard at that.
David, I want to ask you about the Hovnanian CDS controversy, in part because it's a situation that you appreciate well, given your background in leveraged finance and understanding of the credit markets. This, of course, is the one that involves Blackstone on the one side, or the GSO credit business of Blackstone on the one side, and principally Solis, a hedge fund, on the other side. How important is the outcome of that trade?
Look, the thing, first of all, we're a market maker, a market intermediary with clients in a situation like that. And a thing I think that's important is it raises questions about market process and market procedure. In the CDS market, there's been some press recently about having that resolved or having more clarity around that. And what I think is important for all markets is there's transparency and clarity around how market structure works. And so what I think is important, in this situation is that as it gets resolved and it plays out, people have a better or a clear understanding of how credit events or credit defaults, work and what the parameters and the rules of the road are.
In principle, should it be possible to engineer a default? Is that what the CDS market was designed for?
In principle, what should happen is everybody should be on the same page and there should be clarity and transparency around how these contracts work. And that's important for market structure, and that's what I think when this is all over, that'll be the most important thing that comes out of this.
Can there be transparency around a manufactured credit event?
There can be transparency around what is a credit event, how credit events work, and what conditions need to be present for credit events. Yes, I think there can be transparency around that. And look, as markets evolve and market structure evolves, things need to be looked at through that lens.
The statement that the CFTC issued last week spoke specifically to the integrity of the CDS market. In your mind, is that what's at stake here?
Well, I mean, that's what I'm saying by saying it's important for markets to have integrity. People need to be clear on the structure and the way the contracts work. And so I would agree with that statement. It's important for all markets to have integrity.
Does Goldman still have exposure in that trade?
We don't talk about our positions with our clients, so I'm not going to comment on that, but I appreciate your asking.
Well, and here's a client question, and you can decline to answer it if you choose. We've reported, as you know, that there was some tension between Goldman and one of its largest clients, Blackstone in this case, over how Blackstone refinanced Hovnanian and how it engineered the default and the degree to which it might benefit if, in fact, this were ruled a credit event and there were a CDS auction held. Have you been able to resolve that tension? Blackstone and Goldman Sachs are two organizations that are extremely close to each other. We work across numerous businesses. We have deep relationships at the top of the firm all the way down the organization. They're a super organization, a super important client, and they have been, they always will be. We're two organizations that do a lot together and will continue to do a lot together.
David, final question for you. We noticed, as far as we can tell, that you're not on Twitter. You don't have a little check mark next to your name. If you are, you're going to need to fix that. So what's going to be your handle? Because we checked and @DSaul was taken. DJ DSaul is taken by somebody else. I am leaving, and I've said this before on television, I'm leaving the tweeting to Lloyd Blankfein, our CEO. For now. That will continue. But if, let's say, let's describe Lloyd's voice on Twitter as wry and mischievous. What will yours be?
I'm not a forecaster, so I'll manage that, if and when it comes to a point that it's important for me to do that.